has the game changed in terms of the U.S. economy, starting with the Friday Supreme Court decision? Are all bets off?
Yeah, I mean, I think in general, what we're seeing in terms of the U.S. economy is still ongoing resilience, but a lot of uncertainty as a result of the Supreme Court ruling, as well as a result of the subsequent announcement by the administration to impose the Section 122 15% tariff, which have a maximum duration of 150 days. From a business standpoint, this is a highly uncertain environment. It's one where it's very difficult to plan how much you're going to invest, how much you're going to be hiring, and it makes it very difficult to plan in the long run. So in terms of the momentum for the overall U.S. economy, the paradigm has not shifted that much, but we are going to be in an environment where there is likely to be more restraint in terms of investment because of this latent uncertainty when it comes to trade.
What does it mean for growth prospects in the U.S.? Talk about kind of how you guys are calculating the outlook for growth now that, you know, some tariffs are being taken away, but now more are being proposed.
Yeah. So if you put it simply, and you think about the EY-PA tariffs that were imposed, with the EY-PA tariff, you had an average cost of doing trade with the U.S. that was around 17%, 16.9%. That was the average tariff rate. With the Supreme Court ruling that the imposition of these tariffs was not legal, that brought down the average tariff rate to about 9%. Now, with the subsequent re-announcement of Section 122 15% global tariff, you're back up to around 13.5%. So a big share of essentially this potential easing in tariff restrictions has been offset by the new announcement of these new tariffs. In terms of GDP growth, we were anticipating a drag from the EY-PA tariffs of about 1.2% of GDP. Without them, only about 0.6% of GDP. Now, with the new Section 122 tariffs, we're back to a drag of about 1% on GDP growth. So a lot of the relief has actually potentially been offset by this new announcement of new tariffs being imposed.
All right. One step forward, two steps back, it feels like. Greg, I do want to get to what your note you wrote and you put out specifically on this. And you do, and this is some of what you just covered. You say the Supreme Court's decision materially reduces the economic drag associated with EY-PA-based tariffs. Effective tariff rates have fallen, fiscal revenues will decline, growth headwinds have eased, and inflation pressures moderate at the margin. However, tariff risk has not been eliminated and policy uncertainty remains elevated. You just talked about all of this, and I just go to this idea of uncertainty, whether it's over AI spend, whether it's over tariffs, you know, what have you. This is never good for an economy.
Yeah, that's right. In general, business leaders across various sectors always want to know what's going to happen next, even if that means there is a tax increase on the horizon or a tariff increase on the horizon. As long as they know that there is going to be stability in the environment they're going to evolve in, they are able to plan. Without that stability, they're much less able to plan. And you were just talking, Carol, about inflation. And I think it's important to remind everyone that even if there is an easing in the average tariff rate, it's an open question as to how much of that easing in input cost will be passed on to consumers, because we know a lot of businesses have been compressing their margin as a result of these tariffs to avoid passing on the cost to consumers. So it's very realistic that even with some easing of the tariff rate, there's not going to be much relief on the price front, because businesses are not necessarily going to pass on these reduced costs onto consumers.
Yeah, let's talk about the consumer and what this all means for household incomes.
Yeah, I think that's a very important component of economic activity, and we tend to forget it. If you think about how the Fed is conducting monetary policy, it has two mandates. It has an inflation mandate, it has an employment mandate. But the reality is that we're forgetting about the income component of economic activity. And when you look at developments in terms of the labor market, there has been fewer job growth, less job growth. We're talking about a jobless expansion, and wage growth is under pressure. You combine the two, and you have a trajectory for real disposable income growth that is gradually cooling. And adjusted for inflation, real disposable income is below 1%. What does that mean for the average person? It means that they're less able to spend freely. And so we're seeing this deceleration in consumer spending activity as a result of this slower trajectory for income. And I think that's a key risk that we have to be increasingly focused on in a jobless environment.
It makes me a little nervous. It makes me think of something Emily talked about on Friday about, for a while we were talking, was it last year, the year before, a lot about stagflation, of slower growth, but higher prices, inflationary pressures. And, even Fed's Chris Waller says the March rate call depends on the labor market. He's watching the weakness in the labor market. Should we be talking or even thinking about stagflation at this point, Greg?
I don't think it's the right time to be talking about stagflation, in the sense that if you look at growth numbers, they're actually quite strong. And inflation, yes, is slightly above 2%, but it's not alarmingly so. We're not in a stagflationary environment in the purest definition of the sense, where inflation would be at 5% and growth would be 0. We are seeing an economy that's growing at 2.5%, and we are seeing inflation slightly above the 2% target. One thing that I'm increasingly concerned, though, is this notion that not everybody is benefiting from this economy. We have an environment where a lot of the growth is productivity driven, and we have an environment where a lot of the growth is driven by AI investment. Not everybody benefits from these gains, and that means that the income for some may be really strong, but the income for a majority is under pressure, and that in turn is a key constraint in terms of economic activity. So I'm not as concerned about stagflation as I am potentially about downside risk to growth because of this slowdown in real disposable income growth.